Ladies and gentlemen, good day and welcome to the Century Enka Limited Q2 FY24 earnings conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital. Please go ahead.
Thank you, Ryan. Good evening and very warm welcome to everyone. Thank you for being on the call of Century Enka Limited. We are happy to have the management with us here today for question and answer session with investment community. Management is represented by Mr. Suresh Udani, Managing Director, Mr. Krishna Gopal Ladsaria, Chief Operating Officer. Before we get started with question and answer session, we will have opening comments from the management. I will hand over the call to Mr. Suresh Udani for opening comments. Over to you, sir.
Good evening, everyone, and welcome to our Q2 FY24 earnings conference call. I would like to thank our host, PhillipCapital, for hosting this earnings call. Now, let me first brief you on the operational highlights for the second quarter of FY24, after which our CFO will brief you on the financials. Our revenues have declined due to degrowth in volumes of Q2 FY24 by around 11.3% year-on-year to 16,051 metric tons. Demand for NTCF has been affected due to a slowdown in the replacement market, with rural demand having a larger impact on bias tires. Additionally, there is a lower export of tires. We have also observed muted growth in wholesale sales of commercial vehicles, and there is a degrowth in tractor sales. Two-wheeler sales are still trailing at pre-COVID levels. The increasing trend of retailization in commercial vehicles is affecting our NTCF business. Additionally, the NTCF margin is under pressure as a result of increase in cheap imports from China against advanced licenses. We are hopeful of revival of demand in Q3 FY24 onwards. In the nylon filament yarn segment, we are facing lower demand from rural areas. Lower demand in China and consequent dumping into India are impacting demand and margins. In this segment, we are focusing on increasing our value-added product portfolio and reducing costs. On the input cost front, caprolactam prices moved from $15.70 per metric ton in June 23 to $16.43 per metric ton in September 23. With electricity rates at elevated levels, the commissioning of our captive hybrid power plant has helped us in containing costs. Now to update you on our capex projects. In H1 FY23, there was a cash outflow of rupees 85 crores for the ongoing capex. The PTCF expansion is expected to be commissioned in Q4 FY24. Similarly, the expansion of NFI is also expected to be commissioned in Q4 FY24. The dipping project has been commissioned in Q2 FY24. Also, 10.5 megawatt wind and solar hybrid power project executed under the group captive policy of Gujarat was commissioned in July 2023. Now I will request our CFO, Mr. Ladsaria, to brief you on financial performance.
Thank you, Sodhanji. Good evening to everyone. Let me start with the financial result for Q2 FY24. The operating revenue for Q2 FY24 stood at 396 crores, a decrease of 30% year-on-year. EBITDA for the quarter stood at 9 crores, a decline of 76% year-on-year. EBITDA margin for the quarter was at 2.35%. Net profit at 4 crores, there is a decline of 83% year-on-year. PAT margin stood at 1.08%. NTCF sales for Q2 FY24 decreased by around 39% year-on-year to 167 crores, while NFI sales for the same period decreased by around 18% 212 crores. For the first half of FY24, operational revenue stood at 825 crores, which is a decrease of 27% year-on-year. EBITDA stood at 31 crores, which is a decrease of 69% year-on-year. EBITDA margin for the period was 3.73%. Net profit was at 18 crores, which is a decline of 73% year-on-year, and PAT margin of 2.16%. And TCF sales for H1 FY24 decreased by around 31% to 386 crores, while NFI sales decreased by 20% to 404 crores. With this, we can now open the line for questions and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. Our first question is from the line of Madhur Rathi with Counter Cyclical Investments. Please go ahead.
Yes, sir. Thank you for the opportunity, sir. Sir, we had guided an 8 to 10% margin for FY24. So, since half year has passed and we are lower than that, so will we be able to achieve that margin?
Okay. Yes, we had an exceptionally poor quarter in Q2, and if you look at our past results, this has been one of the lowest in possibly last 12 to 16 quarters. We do not expect this kind of performance to continue because this was mainly driven by lower demand from NTCF, and we expect that the margins should revive to normal levels from Q3 onwards. But on an year as a whole, the average margins would definitely get impacted by Q2 of this year, and we do expect that for H2, the margins should remain between 6 to 8% at the operating level.
And sir, will we able to beat our volume numbers for FY23 and FY24?
As of now, it could be closer to that number, but given the kind of uncertainty that has prevailed in first 2 quarters, particularly due to the geopolitical issues as well as the dumping of products from China on the NFI as well as to some extent on NTCF, it will be a challenging task to meet the volumes, but we are still hopeful that the demand should revive in Q3 onwards, and we should be closer to the volumes achieved in FY23.
Okay. Sir, my next question would be, sir, our NFI, we are guided that when domestic consumption as well as textile sector revives, there will be an uptick in that segment. So in Q3, a lot of textile manufacturers and garment manufacturers are guided better H2. So do we think that we'll be able to have better margins and volumes in this segment going forward?
Generally, yes. But as I said, there is a overhang of China's domestic markets not doing well, and a lot of surplus production from China is flowing to India in most of the textile segments, and we see that in our segment as well. That is going to be a determining factor, particularly on the margin front, because of the surplus production as well as the cost advantage that China enjoys on the value chain. That impacts our margins and the pricing that we can charge from our customers. So that these O2 overhangs would determine the profitability, but generally we are positive on H2 revival, which will be determined by festivals as well as the marriage season, which normally starts from October till almost February and March.
Okay, sir, just one question. Sir, are we in discussions for an quality control or an anti-dumping duty on China for these products with the government, as this industry is facing a lot of headwinds right now?
Yes, we are continuously pursuing through various associations and highlighting the volume increase and the low prices at which material is coming from China. And while there is appreciation of the efforts being made by the association, and officials in the government acknowledge that the industry is facing difficult times because of China. Because the elections are looming, it would be difficult to say whether any policy action would happen. But from the industry side, we are all pursuing for both increasing duty as well as anti-dumping duty actions to be taken.
Okay, thank you, sir. Sir, and just final question. Sir, what is our outlook for FY25 and 26 in terms of top line and bottom line? Since FY24 will have some issues, so what kind of outlook are we seeing for FY25 and 26?
We do expect that, one is that our FY25, it could be between 15 to 20% growth on the closing number of FY24. But that, as I said, there are so many geopolitical changes that determine the immediate or the quarterly performance as well as the yearly performance. For example, how does the exports of tires pick up to, particularly Europe, is a major driver for our NTCF volumes. Similarly, how does the Indian economy perform in FY25 will be a very important factor, particularly on the infrastructure side and the spending that comes with the new government. So these numbers will determine the state of economy as well as the state of this industry. But looking at the new products that would get added to our portfolio by end of this quarter, end of this year, we do expect that that is the top line growth we can expect, and we'll plan for FY25.
And sir, on the margin front?
Margins, I think, in similar rates, we expect it to be in the range of, at operating level, between 6 to 8%.
Okay, thank you, sir. All the best.
Thank you.
Thank you. Our next question is from Vipul Kumar Shah with Sumangal Investment. Please go ahead.
Hi, sir. Thanks for the opportunity. So, sir, what is the capacity of the polyester cord fabric project which we are implementing right now and being commissioned in Q4?
We do not give any segmental breakup of our capacities as well as the volumes, because we operate in one segment, which is synthetic yarns. But it will be meeting around 10% of the total demand for the industry, for that segment, and it should be a small share to start with, and we hope to grow that in future once we see success with this small entry and grow this business in future.
Okay, but so is it an import substitute product?
Yes, currently almost 80%, 85% of the demand is met by imports, and this would be mainly substituting imports as well as catering to the overall growth in the PTCF requirements.
So naturally it should carry a little higher margins, right, sir?
As I said, margins are now more determined by a lot of geopolitical and situations, as well as how are the economies doing, which are mainly exporting or which have built capacities in past. So yes, in a generic term, we can say margins should be decent, but world has become very uncertain, particularly in last 2 years, and more stable order could have said that yes, the margins will be more positive, more attractive.
And what are the asset turns for these two projects which will be commissioned in Q4? And what type what increase in sales you can expect from additional tonnage being added in the next financial year?
I mentioned we expect a top line of around 15 to 20% growth with stable pricing. I mean, because the underlying raw material price also determine the sales value. Primarily coming from the expansions which have been commissioned in the last year as well as in this year, and also driven by the volume that would be determined by multiple factors I mentioned in my earlier response.
Okay. And sir, you mentioned that caprolactam prices are again rising, so it will put further pressure on profitability in current quarter, sir?
It is, I would say, rather moving in a range. It is not, this range movement is normal. It's we see an abnormal movement if the prices move by $150 or $200 in a or closer to that numbers if in a quarter. So this range is expected, and it should not have a significant impact unless the movement is sharp in a very short period of a month or so. Over a period of 3 months, if that kind of movement happens, it's normal and expected in this industry.
Caprolactam prices even today are lower compared to the historical prices. So as a absolute product cost, nylon prices are lower compared to historical prices. So even if caprolactam moves higher from these levels, but if volatility is not there, we don't expect any issue on that count.
And so from this 10.5 megawatt hybrid power plant, so what percentage of our electricity will be sourcing from this project, and what will be the expected savings in terms of rupees from this project, sir?
So as indicated earlier, we expect annual saving of between 15 to 16 crores per annum, and which is already started accruing from quarter 2, since the project has been commissioned. At a normal capacity utilization, this should be catering to our about 12 to 15% of the total power requirement combined for the company. And we intend to, in future, to expand this with the policy support both in Gujarat and also for Maharashtra. So we expect that we will grow this portfolio to closer to maybe 25% in next few years to keep a control on the power costs.
And lastly, sir, you have given the sales figure for NTCF and NFY, but will you be able to give the tonnage for both the products for this quarter and half year?
As indicated, we just given additional information of the sales breakup, but we report our results in a single segment as synthetic yarn and products. So we do not give for competitive reasons, the breakup of volumes.
Okay, sir. Thank you very much, and wish you all the best.
Thank you.
Thank you. Our next question is from Anand Munda with Might. Please go ahead.
Hello. Yeah, thank you for the opportunity, sir. Good afternoon. Sir, firstly, wanted to understand that our rated capacity currently is 86,000 tons per annum. Is it practically possible to go up to that level?
Yes. If the demand is supporting, and we have capacity to go up to 86,000 tons per annum on an annualized basis. Okay. It could be one. I would just like to add. See, this is a product where the denier mix also makes an impact on the tonnage. So this is based on the normal tonnage that we expect from the market. So there could be some plus and minus based on the denier mix, but on the normative denier that we normally sell to the market, we do expect to achieve this with the demand side supporting us.
All right. And so the decrease in the volumes, is that only because of because of lower demand in the overall industry and economy, or is there anything specific to our company? Probably have we lost some client, or we are losing wallet share from any of our clients?
No, it is an industry-wide issue. Only difference could be that the client mix is varying between the various competitors. So sometimes in a quarter, certain customers would take an inventory correction or do some other kind of activities which could reduce volume for that quarter. But there is no loss of customers or market share, and we have to look at more at an annualized value numbers rather than only a quarter, because the quarter can sometimes be extremely good or sometimes be poor, like the one which we just completed.
Okay. And sir, so earlier when we were doing the capex, we were guiding that sustainably we believe that the EBITDA margins could be in the range of 10 to 13%. But now we've reduced that to 6 to 8%. So what exactly? Why are we reducing that margin guidance?
I think I don't recollect the number, but that would have been a complete total margin at the EBITDA level, but not the operating margin. We have reduced slightly our projections on EBITDA margin by about, I think it was possibly between 8 to 10% to 6 to 8, mainly because of the changes in the external scenario as well as the threat in the pricing margin pressure from Chinese. So that is the current estimate, and we do expect that once the turmoil and the improvements in the demand for the products overall improve, we could come back to that kind of margin. The second thing which has changed possibly is that the power and fuel rates increase in the short term has been quite significant because of the fuel adjustment surcharges being levied by the state government, and that numbers have actually gone beyond our projections, what we took when the projects were conceived. So that is the second important factor which could impact the margins.
So how much is power and fuel cost for us as a percentage of our revenue?
It's close to 20%. It depends on product prices also. If raw material prices are higher, then that percentage come down. But generally it is around 20%.
Okay. And the full effect of the solar plant coming up has now been factored into our financials, right?
Yes.
Okay.
The existing project has been commissioned, and we're getting the desired power from the hybrid sources.
Okay. And so the PTCF plant is going to commission in Q4. So when are we going to start booking revenues from that? Will that also start in Q4?
No. So being a new product, it will go through a approval process with the tire companies. So the ramp up will be slow, mainly starting at the end of starting from Q2, and we'll start seeing the results mainly from Q3 FY25 onwards.
Okay. And so one more point that you had mentioned earlier in the call was the export of tires to Europe is very important. So could you please elaborate on that? Like, why specifically to Europe?
In fact, the major exports of tire is to Europe, I mean, if you look at the geographical breakup, and that too, the tire export breakup is more towards the farm tires, the OTR tires, and tires which actually use NTCF as a reinforcement. Constituted more than 50% of that basket. So, because Europe, these tires are slowly being phased out for production in Europe, mainly because of the high cost of operations and the issues with energy and other prices. So, and even before the Ukraine war, the volumes were increasing with acceptability of tires manufactured out of India. So that drop of volume definitely directly impacts the volumes of the tire companies, and then directly impacts our reinforcement requirement as well. So that is the reason that this exports to Europe is being a very significant of the total exports is important, because other sections impact has been there because of economic issues, but the fall has been significant in the Europe exports.
Okay. And sir, the kind of contracts we have with our customers, there must be some formula-linked pricing for the NTCF segment, correct, sir?
Yes. For the pass-through of the caprolactam prices.
Okay, and so if we have to, because like we are mentioning that power costs have increased considerably, so when do we renegotiate the contract? Is it an annual contract? How does it work?
It's an annual contract, and all these points do get factored in, but an important overhang is also the import prices from China. So that has an impact on the pricing that we can negotiate with our customers.
And the reason Chinese are extremely competitive is because of easier availability of caprolactam?
Multiple reasons. I mean, it is not only caprolactam, but they have put a complete value chain on the nylon side. And like many other industries, they have a huge capacity which has been set up mainly. The total capacity is for both domestic and the export market. And if the domestic market demand in China does not do well, a lot of that volume flows to the nearby countries, and India is a case where demand is growing, so a lot of volumes of both the products and many other products actually flow into India from China.
All right. Thank you, sir. That's it from me. Thank you so much.
Thank you.
Thank you. Our next question is from Mehul Parekh, an investor. Please go ahead.
Good evening, sir. I have a few questions. One is that have we started the dipping of rayon tire cord for third party?
We are discussing that. We have not started dipping, but since we have commissioned the dipping plant now at Pune, and before we get the full capacity of PTCF as well as the expansion that we have built as a part of the dipping capacity, we would have surplus capacity, and we can do third-party dipping for rayon or even other products if it is suitable in these plants.
Okay. So when we say that we are having Chinese imports coming in at a cheaper rate, we go through a rigorous approval process. How do they manage to sell to the tire companies here?
No, tire companies have been importing from China almost possibly for decades, because there was an import dependence before the domestic capacity was increased, and most of the Chinese suppliers are already approved with the tire companies. So they are regular suppliers to the tire companies, and even in the best of the demand, operating levels of domestic companies, the imports have continued. And one of the reasons for that is that since the tire companies have built up a portfolio of export of tires, they're able to import NTCF or other reinforcement duty-free.
Okay.
Against advance license.
So this will remain a perpetual problem for us, right?
No, the problem is not that quantity. The problem is if the volumes increases significantly and if they come at a very low price.
Okay. Sir, in terms of NTCF for say two-wheelers or electric two-wheelers specifically, is the denier the same, or the weightage of the material is the same, or is it higher?
Till now, the tire companies are still kind of giving the similar tires for both electric and normal IC scooters. But we do hear about new developments being made. So we have still not seen any change in the denier. So the normal tires which were going for two-wheelers, motorcycles, scooters are still being, on the same basis, are being supplied to the electric vehicles. But it can change, based on the developments that happen in this industry, which is quite nascent.
So would it increase the weightage or the denier count? Would it be, because the electric vehicles are heavier, so would it increase that tonnage?
Logically yes, but I can't comment before that. That's something for the tire companies to design, and what kind of reinforcements and weight of the the base of the tire is done. So these are still work in progress for the tire companies.
Sir, and steel belted radials and all, there is also some level of nylon tire cord being used apart from the steel belt. So do we cater to that also, or it is like our material is not used there at all?
Yeah, but that's only for the very small quantities going to that. And we do cater, to customers who make, we normally don't make that NTCF or that fabric. Because that's a very low volumes, but we supply yarns to companies who make that kind of fabric.
Okay. So what is the first half foreign exchange earnings for us? If that figure can be shared.
Just a minute.
Yeah. And do we do any NTCF sales to non-tire companies? Any applications where we are supplying?
NTCF is only for tire companies.
Only for tire.
We do sell yarn, nylon yarns for other than non-apparel, non-textile segments as well.
Okay. And sir, any approximate selling price of PTCF? Any idea what is ongoing in the market right now?
I think it will be, we are still to get into that because the project is not commissioned, but it will be similar to the imported prices.
Yeah, but any approximate figure which would be prevailing in the market?
I don't have it readily available now, but I think you can get it from the import data.
Okay.
Exports were around 27 crores in this 6 months.
For 6 months, okay. Right, thank you, sir. And sir, I had made an email for a factory visit in the last Concall, as you had mentioned, but I had not received any reply from the company. So is it like it was cancelled, or is it, do I write again? What is the...
to whom did you write that?
The email ID mentioned in the letter, like compliance, some common, it is not CEL.
Okay, we'll get it checked. Possibly you can send another mail, and if you have the coordinates of our company secretary or the department, you can just direct it that side. We will...
I would not have it. Is it possible to just give it to me?
On the website itself.
On the website. Okay.
If you can just send it on that other earlier one as well as, and possibly take it from the website and send it there.
Okay, I will do that. Thank you very much. That's all from my side.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask questions, please press star and 1. Our next question is from Hardik Patel, an investor. Please go ahead.
Hi, sir. So just wanted to ask that, the tire companies and even our competitor has been very nice with the results. In fact, JMRF just released their tire, and I guess it is the highest producer of bias tires. So what is going on with our company? Why is the results not really being up to the mark, or, is it something that radialization is, increasing or something like that?
So tire companies make all kinds of tires for passenger cars, radial tires, bias tires, tractor tires, OTR, and normally there is no segmental numbers are given in the results, or I have not seen that even in the presentations. So in our assessments, our interactions with customers, mainly the segments which are doing well is the passenger car segment, I mean the vehicles and the tires for that, plus the radial tires in the medium and heavy vehicles. So these two tire segments are where we don't use NTCF. NTCF volumes are, I mean the tires using NTCF, which is basically biased tires for medium heavy vehicles, tractors, and the 2 and 3 wheelers, all have been not at the best of their health. So their capacity utilization of the capacities for these tires have also been lower. And our interactions with the customers, the large ones that we supply to, and they expect that this should get there should be some improvement in Q3 and Q4 onwards.
So what is the radialization in tractors? Because I believe that it is mostly biased tires, right? And even they have reported a little bit of growth, even though in single digits, but they have reported growth. So just trying to understand.
Yeah, it is all bias or mainly using NTCF, but the major consumption comes from the medium and heavy vehicles, and particularly in the replacement market, because the tires, I mean the sale, but typically in bias segment is mainly inclined towards the replacement market, and the OEMs when the new trucks or medium heavy vehicles are given are normally come out with radial tires, but the replacement market is what drives the bias tire consumption. Mainly.
But company does have a good amount of market share in the replacement market, right?
No, I'm talking of the replacement markets for the tire companies. We supply only the tire companies. So the tire companies' focus is on the replacement market, which has not been doing very well.
Okay. So what is the, approximate timeline that, is expected for not only the Century Enka, but the tire company of bias tires mainly to, kind of recover as of now?
This is more by, now everybody is giving only a quarterly projection. So this quarter onwards, they expect demand to improve, because since the Q2 demand was lower, a lot of companies had actually taken an inventory correction and cut down on production. They have started asking for more volumes and they are increasing the production. So we hope that Q3 onwards it should improve.
Okay, that's all from my side.
Thank you.
Thank you. Our next question is from the line of Madhur Rathi with Counter Cyclical Investments. Please go ahead.
So just wanted to understand our PTCF plant when it will come, will be our cost will be similar to the Chinese producer, or will be a bit higher on that front?
No, there I think we should be fairly competitive with Chinese markets, the Chinese producers, because there's not a long value chain and PTCF chips are available from multiple sources. Unlike nylon, where China has a very dominant share in the world. But since the plants are old and the volumes, they have large capacities, in case their demand, the local is not very positive, or there could be dumping, or more volumes could be diverted towards markets which are growing like India. That risk remains, but from a long-term perspective, we expect to be competitive against imports or from China particularly.
Sir, what percentage of cost PTCF would be for a passenger vehicle tire manufacturer?
Sorry, I didn't.
So what percentage of PTCF would be the amount that goes in, would be the cost as a overall for the tire manufacturer?
I can't comment on the cost side. Normally, reinforcement by weight is between 8 to 10% of the total weight of the tire, and that depends on the tire design and other things. But that's the normal range that the tire manufacturers communicate to us, and but we don't have the complete cost breakup side of the tire.
Okay, and sir, this will go up in EVs which are of heavier tonnage?
The percentage? No, the percentage, the tire weight will go up. So the percentage of reinforcement also goes up.
Okay, so
the percentage would remain the same, but they would normally the tire numbers are increased. If the tonnage goes up, the axles, actually number of axles and the number of tires that go in a vehicle increase, and so for a higher tonnage truck, the number of tires and obviously the reinforcement would go up.
Sir, I was asking from an EV perspective, which are heavier vehicles and number of tons. So in those vehicles, would the number of reinforcement required as a percentage of tire go up? That's what I'm asking.
So as I said, the tire companies actually look at changing the design of the tire. So the tire weight would go up, so automatically the tire reinforcement would go up. If for example, the vehicle is getting, heavier, or like for the SUV segment, they would have more broader tires, so the weight of the tire will go up, and automatically the requirement of reinforcement for tire would be proportionately increasing that way.
Okay, sir, that is very helpful. Thank you.
Thank you.
Thank you. Our next question is from the line of Mehul Parekh, an investor. Please go ahead.
Yes, sir. Sir, I sent an email on the next day after the Concall to cel.investor@adityabrilla.com. I believe that's the email ID given for communication.
Yeah, fine. Okay. Yeah. And I hope you have given your contact details and other things.
I have given everything. I have given including the DPI ID, BOID. I will send the same message again today. Yeah.
Sure.
Thank you.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. As there are no further questions, I would now hand the conference over to the management for closing comments.
Thank you. We thank all the participants in the earnings call. I hope you were able to get all the answers to your satisfaction. If you have any further questions or would like to know more about the companies, please reach out to our investor relation manager at Velorum Advisors. Thank you.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.